everyone, and welcome. If you are here for Startup Prizes webinar. Today we'll be joined by Melissa Withers. But first, before we begin, just a very quick thank you to all of those folks who are helping to support Startup Prize. So we like to start any event by thanking our sponsors. So for 2026, thank you to our presenting sponsors, the Prize Foundation, Louisiana Economic Development, Louisiana Innovation, fueling future use of energy in Louisiana, Phillips Kallenberg Investments. Startup Prizes also sponsor with generous support from the Anderson family, Louisiana Blue, Business First Bank, Caddo Management, Caddo Parish Commission, Schaff and Associates, City of Shreveport, the Greater Bossier Economic Development Foundation, Hurd McElroy Investel LLC, Heidi and Gregory Kallenberg, LSU Health Shreveport, LSU Shreveport Foundation, North Louisiana Economic Partnership, and Ochsner LSU Health Shreveport. So thank you to all of the sponsors. They are the reason that we are here today, and we really appreciate them. And with that, I am wasting no time. We are bringing Melissa Withers up to the virtual stage. So here she comes. Ta-da! Melissa, it's always great to meet another Melissa. No, I'm just kidding. Welcome. Thank you so much for spending some time with us today. I am super excited about what we're going to delve into. However, before we do, I'm wondering if you could maybe just give a quick introduction of yourself, tell folks a little bit about your background, and then we're going to jump right in.
Yeah, sure. I did lots of things before I became an early stage investor, which is important these days. Started some companies, had jobs, and then about a decade ago, found myself working as a professional fund manager in early stage investing. I've had the pleasure, and it really truly a pleasure to invest in over 150 companies over the last 10 years across different kinds of fund structures. When I started my career, I was investing through a traditional early stage venture capital fund. And then about 8 years ago, I started RevUp Capital, which is one of the world's first revenue-based funds. I also am a very active angel investor. I'm essentially a glutton for punishment, and have sat on many different sides of the capital continuum and really continue to love the experience of building early stage companies and investing into companies. But more than anything, I guess for the purpose of this conversation, I'm really happy to say the quiet parts out loud. I've worked on both sides of the table. I've been a founder, I've been an investor, I've been a traditional venture capital investor, I've been an alternatives investor, I've been an angel investor. I've seen things go really well, I've seen things go really bad. And I think that, I'm at a stage in my life and my career where there's really no upside for me not to be fully transparent with, particularly with founders, and share what I've learned from that experience. So really glad to be here to answer any questions that you have, not just about my current investment thesis or focus, but just overall about the whole journey and experience of funding an early stage company and what I've seen and from those different vantage points.
Well, like I said, I remember our very first conversation, and I just felt like I kept going, yes, oh my gosh, yes. So I can't
Love
wait
to
to jump
hear
in.
it.
And we are just going to just dive right in.
Do
So
it.
I know you talk a lot about equity versus non-equity. And I know one of your recent blog posts was like, it's the wrong question to be asking. So why is that like equity, non-equity investment? Why is that a false binary? And what
Okay.
do founders kind of misunderstand about that choice?
Yeah, I think that what happens in early stage like startup programs is we tend to talk about capitalization strategy in very narrow ways, and we tend to talk about this idea that you build a company and then you go out and you raise this progressive round of linear equity rounds, right? You start with friends and family, and then you do an angel round, and then maybe you do like a seed round, and then you do the series A round, and it leaves out a lot of really important factual details about how the vast majority of companies in North America are funded. For example, if you look at the Inc. 5000 list of fastest growing companies in North America, fewer than 4% of them are funded by institutional venture capital. It means that those companies are using all kinds of things that you're not even being like really exposed to. But even pull that back, even in my world, the vast majority of companies that I work with have many different kinds of capital at work inside their companies over time. There really is a capital stack that most companies will avail themselves of. And it's really only an extremely narrow subset of companies that are 100% funded by venture capital, right? And so I think what happens is the story starts to unfold as though there's this path for the most elite and then everyone else, when in fact it's just not really true. And then, in the piece that you referenced, there's another reason why this binary has been sort of advantageous, and it's investors kind of benefit more from tension than they do from truth. And so sometimes it's through oppositional positioning where you can establish your sort of marketing position, right? So historically, there was this sense that if you weren't raising money from these top tier VCs, then your company wasn't any good, right? So it was a
Mhm.
way for those, the sort of top 10% of funders to establish a kind of dominance over the narrative. And so I think that then just sort of spiraled out of control to create this sort of worldview where early stage funding was really either all about venture capital and all about equity funding or nothing at all, when most companies that were very good by all other standards were in fact using multiple kinds of capitals to grow.
That's super interesting. Why do you think that kind of framing or that, I don't know, kind of myth still exists, or maybe that kind of mindset?
Well, I mean, that's a really complex. It's very how do narratives get built, right? I mean, there's a
Sure.
lot. Like
Yeah.
you can get kind of meta on that, like who has
I'm sure we
who
could.
has the microphone, right? But I think just very practically speaking, when you look at entrepreneurial education, the majority of people that are responsible for running our entrepreneurial education programs, oftentimes aren't founders themselves. Didn't build businesses, don't have exposure to that, and so they talk about what they know, or they talk about what they believe, or they talk about what they see. And so I think there's just sometimes a knowledge gap where they're just people, who just don't understand how to think about integrated capital stacks early on. So we tend to talk about the things we know best, which is how to raise money from angels, right? And then how to make that transition from angels to institutionals, right? Because there's a lot sort of published and written about that. So I think some of it's pretty innocent, right? I think
Mhm.
I mean, it's maybe misfeasant versus malfeasant. I mean, it's pretty dangerous and damaging, but I don't think it comes from a bad place. I think
Mhm.
also for many founders, if you're a first time founder, you only know what you know, and you're going to turn to the internet, right, for knowledge. And a lot of what's written and publicized and shared and celebrated does tend to skew towards the sort of narrow edge, that sort of the elite edge of companies that, for any number of reasons, are disprivileged. Are sorry, are more privileged for access to large institutional venture. So
Mhm.
I also think some of it's just the access to information is it's not as robust if you're kind of coming out building a company. I often encourage founders very early on to think about adding a capital mentor to your mentor group. Like we think a lot about get a product mentor, right? Get a mentor who understands your customer segment, get a mentor who might help you become a better C-suite leader. But a
Mhm.
capital mentor, someone who understands the kinds of capital that a company like yours will leverage both now and later, can be a great unlock for folks that are coming into the journey without a lot of experience of their own in terms of how to layer different kinds of capital into their business.
Well, yeah, and speaking of that, what a great segue, Melissa.
Nice.
Speaking of that, like, having that kind of capital advisor or capital position, like what maybe could that capital strategy look like over time, for a company? Like if it's not an either or, like
Yeah, I
talk a
mean
little bit about what that
I
stack
mean
could be.
at the simplest level, you just want to you really need to understand some things about your business before you bring outside capital in, right? I mean,
Mhm.
again, like you have to almost unpack that because there are certain companies that I think are going to be hyper dependent on high risk speculative capital that will like if you're rockets and robots and biotech and you have a long path to market and a long path to revenue and you have this sort or you're just the kind of really like edgy company that's super high risk, high reward, then yeah, those kinds of companies are going to use less diverse kinds of capital. Although even those companies might use SBIR grants, right? Might use strategic R&D, partnership funding, right? So even in those cases, those companies are going to use more than kind of just going out and asking equity investors for money. But I think, just the capital stack that a company builds needs to be pretty unique to the company, even though at the end of the day, they're more categorically unique. It's every company is not really a snowflake. There are actually kind of categorical ways to think of yourself.
Sure.
But what you have to sort of think about is, the what kind of need do you have today, and what kind of need do you think you'll have tomorrow? And then how do you think about your eligibility, right? So eligibility for capital is a really great question to ask yourself. Where are you, and what kind of capital services companies like yours, right? The cost of that capital and the contours of that capital. Is this the right like cost of capital? Like sometimes and again, sometimes you just get forced to make decisions that you don't even feel good about, and we've all done that. For example, if you are a product company, equity is a really bad way to fund inventory, right? So like that would be it's a very obvious example of a very high cost of capital for a relatively low ROI. That said, if you're in a real pinch and it's the only way you can get that, $100,000 that you need to keep going, and you're probably going to take the decision, right? So it's really understanding your underlying unit economics. It's understanding the capital eligibility, like milestones and barriers that you have. And then also there's like a meta factor at play, which is where are you building your business and what networks do you come from, right? If you are a founder that's building outside networks of privilege, you will not have access to the same capital as a founder that's building within networks of privilege. If you do not have access to wealthy friends and family, and when I say friends and family with like a capital F, like then you're not going to have the same access to that, right? If you're building your company outside a kind of top tier capital market, well, then you're going to have a harder time getting access to the funders that tend to want to invest in those things. So there's also like a self-awareness, right? And again, not that you can't overcome all of these things or shape your business in ways that better match the patterns. Capital just matches patterns, right? And it doesn't really break its patterns for you. So what you have to really understand is across that whole matrix of who you are, where you're going, what your downstream potential is, the cost you're willing to pay for that capital, right? Put all that in kind of in concert, and that should start to put guardrails around your capital strategy. Or in some cases, maybe not to be like Debbie Downer, rather than guardrails, it might actually expand the optionality and expand the things that you're thinking about in terms of trying to find the right capital at the right time. But there's no singular capital strategy for any one kind of company.
Mhm. So it sounds like a couple of things you can kind of be thinking about is like kind of your own market, like where you are geographically, what you have access to, eligibility, like what is actually allowed for your company or what you would be qualified uh, to apply for if like let's say you're looking for like non-dilutive funding, things like that. You also talk about like what jobs that capital is doing, you know. I wonder if you could walk through maybe how founders should be thinking about that and what you mean by that.
Well, again, without having a real world example to put that into, like that it matters with the real world, like the variables
Mm.
filled in, right? I
Mhm.
think the example, like the inventory financing example, is a good one. If you're looking
Mhm.
for funding so that you can purchase, a an order, right? So that then you can sell it. That's a different job than I'm looking to hire someone who's going to help take the company to a new level of growth. And that person, I can't really, they're not profitable. Like everybody you hire in a company, there's a time to profitability, right? So if you go out and you
Mhm.
want to hire a biz dev person, they might not be profitable for 6 to 12 months, right? It might take that long before they produce the revenue, right? That the
Mhm.
company that would offset their salary, right? So then that's a different use of capital. So stretched out over a longer term. You may also ask the question, we want to do something inside our company that's going to really create a new inflection point of value, right? Like this investment into this set of activities is going to make the company worth more not maybe not just make more money, but actually worth more on the other side. That's really different than the previous questions, right? And so different kinds of capital track to those use cases and track to those expectations, and you'll pay a different cost of capital based on those things. So you might pay a smaller cost of capital and a more fixed cost of capital for an inventory financing. You may pay a higher cost of capital for something that's a more risky investment into long-term growth, but it may be in some ways it may be cheaper in the shorter term, more expensive in the long term. Like there's just different kinds of capital. You want it to align with what you're going to get out of it. Think about, people always talk about investors wanting ROI. Well, you should want ROI on the capital that you take into your company too. So just always ask yourself, what's the return on investment that I'm going to get by deploying this capital into my business? And make sure that the return on that investment aligns both with the cost of that capital, but then also when you start talking about equity investments, then make sure it aligns with the expectations of the investor. Because that's, if not, then you're probably going to you're probably not going to be successful chasing that money. If in the end your story of ROI doesn't align to the investor's story of ROI, it's a big reason why investors don't invest, is that there's just misalignment on the return on that investment. So you want to understand your internal ROI, what you want to achieve, and then you want to look for capital where you have at least a modicum of alignment, right?
Mhm.
Sometimes you stretch a little bit. I mean, sometimes we have to be a little performative for capital. I don't want to give you the impression that you don't always get to choose exactly what you have options to, but certainly aligning that ROI is really, really important. And misalignment can cause a lot of trouble for founders, particularly if you've never experienced that before.
Maybe say a little bit more about what that misalignment could look like and what that might
Yeah,
do
I,
to a
I
founder
sometimes think
or
of
a
them as
company.
like call them like pretzel problems, right? It's like when a founder kind of twists themselves in knots in order to get a funder to find them attractive. And if you're successful in that, I always say it's hard to untwist a pretzel without breaking it, right? You want to make sure that when you twist yourself into a shape to match a pattern, that it's a shape you're willing to hold. So you'll see it especially with early stage companies that tell the story, like you get to the part where they describe, okay, if you give me this $1 million, this stuff is going to happen, right?
Mhm.
And again, things don't always go as we plan, but if what ends up happening looks nothing like what you said is going to happen, well, you're already in that pretzel shape. So now you can't unwind that and just realize that my business is taking a different trajectory. And I mean, you can, but there's often consequences for that.
Sure.
So this is especially important when you make the transition between kind of early equity and later stage equity. Sometimes what the way to think about is the difference between giving away common stock and giving away preferred stock. So once you sort of move into the realm where you have preferred stockholders involved in your business, those preferred stockholders tend to have privileges, right? That affect how you operate the business. For example, in a round where you're now kind of moving into that realm, you may be asked by the investors to establish a governance board, and that governance board may have one or two seats that are held by preferred stockholders whose job is to present and protect the rights of the preferred stockholders. You're a common stockholder, right? Like you're like inherently not. Now you may in a good environment, you're all aligned, you're all trying to get to the finish line, but you're not actually the same. And a lot of the outcomes that produce good rewards for preferred stockholders might not be good rewards for common stockholders, and vice versa. Some of my favorite outcomes for founders have produced pretty good outcomes for the common stockholder, but not great outcomes for the preferred stockholders. So you kind of want to, like, when you start to settle into different kinds of capital, the stakes can go up if you start to shape yourself into the pattern. And again, oftentimes no like intent here, just, you're following along, you're going with the flow, you're raising this round and you're like, yeah, we tell you go to startup school and we tell you that in order to be eligible for this kind of funding, your traction slide has to look like this. You're like, we tell you to do it. We coach you to build a hockey stick slide. We coach you to make like unrealistic projections about we tell you to do that, then you do it, and then for any number of reasons you may discover that that's not quite the track that you're on. Well, it's like a more like an escalator. Once you get on it, you don't really get to just decide to like walk down it, right? It's very hard to unwind that. So I think these are kind of like pretzel problems. And then the other kind of simpler version of that is when you go out to look for different kinds of capital, you sort of project a story that you just can't substantiate. And what what happens is you just waste a lot of time. So I'll often see companies that are presenting a story that, just they can't really substantiate. And so they'll come in and having trouble getting these investors excited and interesting. And I have to kind of break the news to them that their story that they're presenting is really they can't substantiate it. And in the absence of substantiation, that's where privilege matters. If you don't have a lot of social proofing, or you don't come from those networks of privilege where you've been kind of credentialed, you're actually asked for proof that you might not have. So that it's a simpler way, like a little bit less catastrophic, but a simpler way where getting your capital strategy out of alignment with what and who you really are can just cause friction in your business and slow you down.
Yeah. Well, we've been talking about kind of raising and most of the time people are raising because, well, they need that funding to keep stretching that runway. Um, I know there's a lot of pressure on founders sometimes to bootstrap, to be scrappy. Uh, where do you see kind of that, I don't know, that balance, I would guess, between being super scrappy and like trying to save money and hold on to it and try and stretch that dollar.
Yeah.
I
Yeah,
mean,
this is I have
go
a
ahead,
this is
just go
this is yeah,
ahead.
no, this is really important because I think that there are like extremes to
Mhm.
that. Like I mean I think I think we use the words capital efficiency a lot. Like we just throw those words around. It's like word salad. It's like Olive Garden, all the breadsticks and salad you can eat, right? Like we just toss it around like capital efficient, right? Well, like being broke does not make you a capital efficient company, right? So the true definition of capital efficiency is the ratio of what you get out for what you put in. And if you get out a lot for what you put in, then that's at the simplest form that's capital efficiency, right? And then capital efficiency is the ability to continue to get a lot out over time without having to continue to put a lot more in, right? But
Mhm.
just simply being broke, that sometimes, like, in order to cover up our own uncomfortable feelings about just being underfunded or under resourced and broke, we'll even start calling ourselves capital efficient. Like, and it's kind of, you can get yourself in trouble with that because what you may be doing is actually setting yourself up for failure, because a chronically under resourced company is more likely to have bad outcomes, right, than a company that's appropriately resourced. I gave it a word last year. I wrote a blog about don't get skimp wrecked, because it's like watching a slow motion shipwreck, right? Like you see this company and it's as it's coming kind of like out, it just keeps getting pushed up to the rocks because it doesn't have enough resources to get out into open water and get out into the safety of open water. And it's something that you see happen a lot. And it's just pulling back on the wrong things. And not, again, sometimes you just are really in a pinch and you don't have the money. Again, like so much of business building can just be like the reality of where you are. But there can be other ways to think about resourcing your company besides just raising money. But under resourcing your company is as dangerous as what we call hyper capitalizing your company, right? The consequences of that are different, but they're both pretty bad. So I will often push back whenever an early stage company says they're capital efficient, it's almost never true, because you don't have enough economics yet to even know what the full costs of operating your business at scale will be. So if any early stage company describes themselves as capital efficient, I typically, what that means is that they have either chosen not to or have been unable to bring much outside capital into the business. And so they're using that as like a badge of honor and courage, which in many ways it is. I mean, if you build a business and you make any traction at all without like support, like it is, I mean, I've done it. Like it's hard work. But I think I really encourage founders to not over glamorize underspending, right? And part of that is
Mhm.
just all the weird machismo in entrepreneurship and all the chest thumping and right. And then people get a bunch of money, then you spend it in all the wrong ways. Like it's having a more healthy dynamic with early on understanding the difference between being broke, being capital efficient, and then knowing when to invest into growth and feel okay about it. founders that I've worked with who have a lot of fear about running out of money because they didn't start with a bolus of superfluous resources, often as
Hmm.
humans, not even just as found, right? These are often humans that probably didn't grow up with tons of extra money and therefore too, when they run their businesses, didn't have tons of extra money. Well, that like again, then there becomes this unwillingness to take financial risk, right? All very normal, but you almost have to understand, it almost goes back to like understanding your own relationship to money, that because it how your own personal relationship to money will actually have a pretty big impact on how you run your company and your relationship to funding. So definitely there are a few things that you in it's inside every company that you just can't afford to skimp on, because the cost of skimping is more expensive than the risks of trying to bring in that outside funding.
You want to say what those things are, in your opinion?
Well, it depends on the company.
Oh
Like
yeah, I
there,
guess yeah,
like I,
that is
I
true.
mean, like it's
Sure.
not the same for every company, but I
Mm.
do think there are a few things now that are really challenging for all companies. I think it can be very. It's not a good time to pull back on funding your AI strategy. And again, I don't mean that hyper bloviating edge case AI where like you're. I mean the kinds of use cases of AI that every company has to have today to create operational efficiency and effectiveness. Like it's not the time. You like it you and that's not something you can just do on your laptop. Like oftentimes that does require an actual thoughtful strategy of investment. Even if you're doing a lot of it internally, right? Like just that's time you're not selling or time you're not building something else. So I think that's one area where you just can't afford to pull back. I think right now, if you're doing any selling or like any market facing activity, if you're actively selling and not still kind of pre-selling, the AI has really raised the stakes for authenticity. And companies today, if you had asked me 10 years ago when I started investing, did a company have to have a founder-led brand? I would have said no, right? Like, but now, almost from the earliest stages of inception, nobody wants to hear from a logo, right? They don't. We want to hear from human beings. And you might be a really great founder who's super great with customers and super great with product, but you just might not be comfortable as a spokesperson yet, right? So that can sometimes mean that you need to bring in and spend on resources to help you create a founder-led brand. But in the kind of, the demands of authenticity in the age of AI, it's something that you just can't afford not to do, right? So there's like that's another one where categorically, I think it's a very difficult place to be pulling back rather than leaning in for investment. There
Hmm.
are lots of others. And really, at the end of the day, you have to, the most important thing you need to understand as a company is what are your growth levers? Not what are all the growth activities that you do, but what are the growth levers? And it's not the answer. There aren't not five growth levers inside of an early stage company. If you're sub $10 million in revenue, you do not have five growth levers, right? You might have one or two. So what are the growth levers? And ask this yourself, are we fully depressing that growth lever? And if not, what do we need to do that? Right. So kind of, figuring out that should illuminate where are the places where underinvestment is likely to have the biggest impact on your company.
Mm-hmm. That makes a lot of sense. Uh, as founders are building, I wonder if you could speak a little bit to, we've kind of touched on it, but like the idea that, if you don't raise equity, it's because you couldn't. And, maybe a misperception out there. Why is that wrong? Why should founders not be so concerned on that side
Well, I'm going
sometimes?
to split that into two things. First is
All
the
right.
word equity is a tricky word to talk about like it's a monolith. There is a huge difference between raising money, equity money from friends and family and angels and raising institutional venture, but they are both equity. And they are often, when we talk about venture capital, we are not careful to remind ourselves that it is not a monolith, right? They're as different. An angel investment and an institutional VC investment are so structurally different that they need to be treated as such. But we tend to lump everything under the like everything that uses some version of an equity, even the equity structure of an angel investment looks nothing like the equity structure of an institutional venture capital investment, right? But we tend to just use the word like it's mono. So first, number one is like asking yourself, like, what kind of equity are you talking about? Are
Mhm.
you talking about early equity, right? So friends and family and angel. Are you talking about middle equity, right? Which is sort of small I institutional, or larger individual investments? Or are you talking about institutional? And then there's even a fourth category, which is like coastal institutional, right? Like there's 10 firms, right? Kind of coastal institutional. Each one of those sort of is its own category. So I think first, when you ask yourself, like, I'm looking to bring dollars in, it's really difficult to not raise early equity. There's not a lot of other options down there, right? It's the kind of, and it's we call in the very beginning, it's like you're walking around money, right? It's the money where you can't securitize anything, like you have no revenue, right? So um, I think first and foremost, it's just important to know that there's a lot of nuance and contours to capital that get lost when we just use these monolithic terms like venture capital, right? So that's kind of point number one. I mean, I think a lot of times when a company can't raise equity, it's because they actually can't, because their business doesn't track to it. Right. And there's no shame in that, but it is because you're just not likely to produce the outsized exits that particularly, let's think group three and four, right? If you're talking about institutional, any kind of institutional equity, these are funds that are looking for companies that are going to have very, very high valuations and very high exit multiples. And that is actually less than 1% of all companies kind of end up tracking to that. So in many cases, if you can't raise institutional venture, it's just because you don't match, right? Now, there are, of course, some socioeconomic dimensions to that are not strictly about merit. Like we started there. Like it's not a meritocracy. I've seen like bad companies raise money because the founders were really deeply embedded into networks of capital. I've seen good companies not be able to raise money when they were just as good as the person that did. And then obviously this breaks down. You have gender, you have race, you have geography, right? So I don't want to imply that, it's merit based because it's not. But even if you get into the space, and you break through some of the sort of socioeconomic barriers to access to that kind of capital, you still have to track in some degree. So there are just a lot of companies that really aren't going to be unicorns. You're just not. It's not going to happen. I think when you're talking about equity, that's kind of on this side of the spectrum where there's more flexibility. Um, you have to track to the pattern, right? And so if you're not successful at raising money, then you have to kind of wind back and ask yourself, is it the story? Or is it the business, right? There are two parts that kind of go into raising money. There's the actual business, and then there's the story you tell about it. And sometimes the story we tell about our businesses is the wrong story. Like a business can have more than one story. It all depends on how you want to tell it. And
Mhm.
that's not because you're being disingenuous. It's just that you're early. The future could take many paths, right? So part of it is whenever someone's kind of thinking about fundraising, I always kind of probe a little bit first, like, well, tell me about your business. And then tell me the story of your business, right? Because sometimes there's an opportunity to do some realignment there, where sometimes the blockage to bringing some capital into a company is performative. It's that the narrative isn't the right narrative, and then you change the narrative, and then you increase how you pattern match to the capital providers, and you might be more successful, right? So that's kind of the job number one is when you're thinking about your capital strategy is you got to kind of understand what's my business, and then what story am I telling? And then if you think that the barrier is, if you think your business objectively tracks to some kinds of capital, and you're not feeling like you're having luck getting those investors to kind of resonate, well, then you can
Mhm.
try to see if there's a better way to tell the story. And it might just be gaps in your own knowledge about what certain kinds of investors are looking for. I mean, I work with really smart founders all the time who just kind of didn't fill a important part of the story. And then once they did, they had more traction in their investor conversation. So sometimes you can fix it by fixing the story. Other times it's actually a problem with the company where the company just isn't actually meeting the benchmarks of eligibility for that kind of capital, right? Which the
Mhm.
investors will never tell you that. Like it's like sometimes they'll say it by saying, keep in
Come on,
touch,
guys.
come back later. Yeah,
Right.
but like
Yeah.
it's most investors are not really motivated to tell you hard no. Because what if, when I turn my back on you, you do something great, or worse, even more, like this is even more kind of distressing. If you convince someone I like to give you money, And then I'm like, because there's a lot of FOMO in investing, a lot of following.
Hmm.
Well, then if I already said a hard no to you, you might not let me in, right? So there's just, and then the other reason is just human. It
Sure.
takes energy to give people real feedback, right? Like deep feedback. It's just easier for me to say, oh my God, Chris, that is so cool. You know what? Keep in touch, hit me up in a couple weeks, send me some updates. We'll see where things stand. You're maybe thinking that's a maybe, and I'm thinking that's just I'm not gonna even remember this conversation after we hung up the
Right.
phone,
We'll
right?
see if they
Um,
we'll see if
yeah,
they write back. Yeah.
I don't do that, and my partner doesn't do that, and I have lots of investor colleagues who don't do that anymore because it's not right, and it doesn't. I'm willing to have it cost me a little more, like I'm willing to take 5 more minutes to actually explain why I'm not the right investor for you, and maybe later. But a lot of times you'll get a lot of like keep in touch. This is so cool. This is amazing. I love this. But, it's not a fit right now, but keep in touch. And it's probably never going to be a fit.
Yeah. That's like such a bummer too.
It is. It's really. I
You
mean,
know,
more and more
it's
investors. Yeah,
really
more and more investors. More and more investors are getting better at that because
Mm.
then you don't keep coming back actually like it's all just
Yeah.
kind of incentive driven behavior. And so I should say that trends are changing. I'm pretty old, so there's a generation of investors that I think are finding ways to be more transparent with founders and so but you're still going to get a lot of formulators because
Hmm.
sometimes that's
Well,
just
I
the
mean,
like only thing I know what to say. Because there are some times
right.
when I'm like, I don't know, keep in touch. I don't know, just keep in
Well,
touch.
and I'm sure there's also times when, depending on when you're seeing certain companies, like they're super early, they're super young, and it's just like it is too early right now. And
Oh
like
yeah,
it's
that happened.
super
Like
interesting, like stay in
that's
touch. But
that's a great point. I mean, I think the other thing I think we did like the reason why we can't have nice things is because of all the things that the investors have told you or have said over the years that have become kind of part of this like canon of thinking. I think investing sort of got has been projected like it's hunting. I think it's more farming, right? And I think invest raising money was historically presented like of going out on a big game hunt. Like you get ready for the hunt, you load up your backpack, and then you go out on a hunting expedition, and then you bring home, the slayed beast, and everything is well in the world. I don't think that's actually an effective metaphor. I think there's a lot of farming and fundraising. There's a lot of relationship building. There's a lot of just you coming up your own curve and having conversations that change the way you think about your company and the kinds of capital you might want to invite into your business. So I think it's fun, and I have to raise money too. So I have to raise money all the time, right? I don't. The only reason why I have money to write to you is because somebody gave it to me. So I think even in my own experience raising money for my companies as well as for our funds, it's like 80% farming and like then like yeah 20% sometimes you just get up there you get your bow and arrow and you're like I'm gonna go for that. I'm gonna go for that big game, and sometimes it works, right? But it's really the hunt the farming is what sustains your capital strategy, and the hunting and the opportunistic stuff is in my experience across 140 companies the more common way that we build our capital strategies.
And I know we've got folks joining us too, and I want to make sure if y'all have questions, please like throw them in the chat. Don't waste this opportunity, and I'm happy to like get them to Melissa. Um, I also want, because you have a little bit different of a funding strategy and thesis with RevUp, I wonder if you could speak a little bit to
Yeah, sure.
revenue-based
Yeah.
capital. And like, because I
I
think it's not as common, I mean, it's out there, but maybe not as common to folks. And I think people would be interested in kind of better understanding how that works and why it might be attractive for their company
Yeah,
and
sure.
where they are.
So when I started early stage investing, I did 90 companies through a traditional early stage equity fund. It was through that process that I became very frustrated by the contours of the traditional VC model, um, specifically in equity investing in the VC model. The only way to win is through exits, right? Which means from day one, my job is to get you to sell your company, like whether it's good for you or not, right? Like, and so
Mhm.
what we look at, and this was especially true 10 years ago when I started, you're really like, it all drives to these sort of weird standards about what's investable, right? Because you're not looking for a company that can maybe generate 20 or $30 million in revenue. You're looking for a company that's going to produce, a $500 million exit, right? And so it just limited the things that we could do. And after doing 90 companies, I didn't like the companies we were investing into. I was saying no to companies that I'd much rather invested into and saying yes to companies that I just kind of knew, and then the other thing with that kind of model is you are sort of like, we invested in 90 companies, we expected 80 of them to die as quickly as possible, and then you try to pick the two or three or five or whatever based on your fund that are going to make the big return. I mean, it's just sort of a weird way to like add value and build businesses. So after that experience, we also realized we were kind of ruined for all other work. Really enjoyed building companies, really enjoyed early stage investing. So we created one of the world's first revenue-based models for early stage investing. Not bank-like. I mean, there are lots of groups that do it at a very like high throughput level. We look like a boutique equity fund. We only make 10 to 12 investments a year. We're with our companies for 3 to 5 years. We're only investing if we're adding value beyond our cash contribution. So I didn't want to start a bank and I didn't want to be a lender. But what I wanted to do was be exit agnostic. So I wanted to be able to invest into companies where I didn't have to be certain that the company was going to produce this singularly magical exit, but I could feel confident that this company could grow from where they were today to meaningful traction. So specifically, we built our fund to invest into companies that are sending that $1 to $10 million growth curve. And we can also talk a little bit about like why everything gets hard at $1 million in revenue, right? Like why, like you would think it
Yeah.
would get easier, why it gets worse. And so the way that it works is instead of taking equity in the companies we invest into, we use what's called a revenue contract. So companies return a relatively small percentage of revenue, somewhere maybe 4 or 5%, over a relatively long period of time, with revenue carefully defined, right? Revenue minus COG, revenue minus what it has to be real revenue, right? Revenue that's like comes into the company. And we do that until a company hits a fixed cap that's anywhere between 2.25 and 3x, which is very different than the 7 to 10x that people are looking for in venture capital. So just straight out of the gates, we have the flexibility to invest in a very broad spectrum of companies. And then lastly, we designed it to fit kind of for companies that were in between that early equity and later stage equity. So by way of example, the companies in our portfolio raised about $50 million before we've invested, but they've raised like $150 million after, right? Because for those that really were on a trajectory where that later stage equity made sense, we are typically investing kind of before that reality is sort of comes into full vision. So it's just a great place to be. We invest about 80% B2B, don't do too much consumer anymore. But as a consequence, we have a thesis that we don't invest into pre-revenue companies, right? We don't invest into companies that don't have a reasonable pathway to grow, right? Which when I was running a venture capital fund, every company I invested into was pre-revenue, right? I don't think any of them had revenue, right? So again, and then some of the dollars that my companies raised before we invested came from those kinds of investors, right? Angels and small institutionals and things like that. I don't know if that's sufficient, but
No, I love hearing it. And it's
I
very
can't, the
interesting.
chat, I think Melissa there, I saw,
Are
I
you,
don't want to open up the chat and get distracted, but I
no,
think
no,
there was
no.
a
I've
question in
got
the
it.
chat.
And
Okay, good.
Ava's like throwing some in. So we're going to go it because I will say this. We're going to do some questions from our friends in the audience. But I do want one question in the back of your head to end on. So you can just kind of let it percolate while we're answering these others. And that is,
Not how my brain works, but thanks.
uh, that's fine. It's great. We're going to do a little challenge for you today then.
Okay, all right.
And that is a shift that founders could make, just kind of that would materially improve how they are thinking about capital and bringing capital into their business. Just a mind shift or just a think. We're going to put a pin in it there.
Okay,
Uh,
all right.
but thanks so much for your question. So Eva was saying that she has encountered early stage VC funds that show an understanding of their portfolio companies pivoting as they are still seeking that product market fit. Is that common for those earlier stage VC funds to be kind of open to that pivot?
Totally. Oh yeah. There's no such thing as not pivoting really when you're that early. Like it's really uncommon. It's very uncommon for a company that's that early to not look very different a year or two after you meet them. Yeah.
And maybe she's also asking about maybe some examples of partnership funding or strategic R&D money that deep tech startups could potentially access.
Yeah, I mean, so I'm not a deep tech investor, so I can't tell you go here, here, or here. But I'm based in Boston. I spent 6 years at MIT. The great irony is I started my career in biological life sciences, working at the intersection. Oh, my dog's here to say hi. the intersection of basic research and commercialization, and it's the only thing I don't invest into. But that's an area where it's super important to figure out if you can create early relationships with downstream partners, right? Where there are often pools of dollars that are designed to be very flexibly deployed into early stage technologies, sometimes with provisions and restrictions that you have to be really cognizant of. But it's a lot of early stage companies in deep tech today are availing themselves of that. There's right now, if you're in like it's a great time to be a defense company, right? There's a lot of government money that's going into defense research. It is very difficult to rate purely subsist on equity money you raise unless you are a serial founder coming out of a successful hard tech company. You will certainly need to avail yourself of those kinds of dollars. There are also a couple programs that I've just participated in different places that align deep industry players with early emerging tech. Sometimes those programs can be a great way to start to explore those relationships. I will say something that might be important, that's not really just important for deep tech, but all companies these days is when I started building companies and making companies, there was nothing wrong with a company that kind of knew it was a product versus a company. And then about 10 years ago, everything like that, everybody just wanted to be, everything needed to be a company. And people raised a ton of money to build market facing infrastructure to bring a product to market. And meanwhile, some of the most successful things that happened were companies that recognize, I call them companies because that's what we call them, but recognize that they had a really great product, but probably shouldn't invest in all of the market facing apparatus to bring that product to meaningful scale rather sooner rather than later to be thinking about who are the downstream players that are already invested into all that market facing apparatus that are it's very often acquiring products sooner than you might think. And I think now we are having that conversation a lot because product has become much cheaper to build. Market-facing apparatus, however, is still relatively expensive because there's still a lot of humans involved in how things get marketed and sold. And so I think I'm very glad to see that more unilaterally across my colleagues, we're having the company versus product conversation much earlier in a company's life cycle in a way that's destigmatized. That used to be a way of like insulting like a founder. He's like, oh, it's just a product. I made more money, and I can show you founders who have made more money knowing that they had a really great product and sold their products, air quotes, made way more money than the people that raised another $10 million to sell $2 million of it. And in the end, made half as much, right? Like it
Mhm.
just didn't matter because when you think about what it really takes to sell, $10 million of something, it costs a lot. So I think in hard tech, especially, there's really understanding early on, do you need to build market facing infrastructure to sell this, or is it just obvious that you're never going to be the one that can raise enough money to do that? And if so, you really want to dedicate yourself to building those internal partnerships sooner rather than later to figure out what are your either co-development, co-selling, channel selling and or early acquisition opportunities because that can be a much better outcome for everybody. Remember, like, your goal as a founder is usually because you want to see the world use your product, right? That's why we don't start it to make our investors happy, or we start because we have an idea that we think that can make the world better for somebody, right? We think that this product or service is going to make the world better for somebody. And the end goal is to actually see that happen at a meaningful scale. It's very, very difficult to build all of the apparatus yourself to fulfill that vision. And sometimes the fastest path to achieve that goal is to work with someone who's already invested in building that market-facing apparatus.
Yeah, that makes a lot of sense.
Yeah.
Well, speaking of sales, here comes one from Tammy. So Tammy has said that they've bootstrapped their company and need about 250,000 to get into deeper waters. But right now, they really don't have those relationships with the really high net worth individuals. So they have revenue, they have a proven model. They just need to spend money on that kind of marketing awareness. Their future clients are easy to sell when they're in front of them, but what they're trying to figure out is, should they continue to find investors, or is it better spent on the sales side?
Well, Energy is almost always better spent on the sales side than fundraising if you're having trouble fundraising. However, if you are it like we just discussed, if you're really can't hit that next level of growth without outside capital, then you probably can't abandon looking for outside capital. A 250K for a bootstrap company is an angel round. So first and foremost is just make sure your fundraising strategy knows that, and that the kind of funding you're looking at doesn't mean you couldn't find a small institutional. Again, everything is comes back to some detail. Are you in an area where there's a bunch of family offices or small institutions that are writing $50,000 pre like so again, if you're I'm not, it's not to say that institutionals won't fund a $250,000 round. It's just not that it's not, it's a little atypical. Most $250,000 first money rounds tend to be angel rounds, and they come from people that write anywhere between $5,000 and $50,000 checks, and they come through networks of what I'll call affinity. So sometimes if you just don't have like a rich network of people, like you're just like they're just not people you can dial up. And I was just helping a founder on this last week. Then the way to kind of hack into that is to think about networks of affinity, AFF, not infinity, affinity, because that kind of investing is very, very intimate. And the people that are going to want to take that risk are going to do so because they're compelled by you or what you do. And it like the people, angel investors write checks not because they really think they're going to make a lot of money on your company. They write checks because they want to get on the ride. And they want to get on the ride because one, they fall in love with you and they're just like, Tammy, I want to get on Tammy's ride. More often they fall in love with a combination of Tammy and whatever Tammy does. Maybe they worked in that industry, still work in that industry, came out of that industry, have a personal experience that vests them into a better solution for a space, right? And so you look for first those kinds of affinities, and then you kind of use your extended networks to try to find those people. But then you also think like sometimes if you went to like colleges and universities that you might not have thought about for the 20 years ago when you graduated, there are often angel groups that form around universities, right? Now again, not all, but lots. So then okay, so like what affinity groups can will I be given access to more easily than just like cold calling people, right? And so you start to just sort of build out like what's my affinity network look like? And then you can just try to use old fashioned, like bribing to get people to introduce you or to connect you into those networks. So wherever you're based, looking for conduits, basically think channel partnerships. If you're good at selling, think channel partnerships, right? If you know that there's like an angel group and you know one person, right? Like figure out if they could get you there. In terms of your eligibility for other kinds of funding without knowing, I can't really give you any advice because I don't know how much, if there's a big difference between having $50,000 in revenue and $500,000 in revenue, right? So it's always dangerous to give advice on non-dilutive funding, but again, like looking to see, okay, because also, are you profitable? Are you not profitable? Right? Like, what are the things that you can look at? But if you haven't, looked at other kinds of, grants, competitions, if you're a really great company with a lot of progress, like I'm not a huge fan of most startup accelerators, but there are a few that offer, a decent investment and they're very good at helping you fundraise, right? So it's kind of start with your affinity network if you don't have rich friends and family, and then kind of, I think it can give you a place to start.
I love the idea of universities. I have seen a lot of that lately with funds that are being run out of universities, not only for like
Yeah.
students and for
Yeah.
faculty, but also alumni, any sort of connection.
Yeah, I went to
I know you
Northeastern, and
probably,
whenever
yeah,
someone sends me a note on LinkedIn and they're a founder and they like went to Northeastern, I'm gonna look at their deck. I just can't say no.
yeah.
Go
I mean,
Huskies, right? Like no, it's or if someone is invest or if a company, a founder reached out and they're in a space that I'm just really passionate about, I'm gonna look at the deck, right? So it's just a way to turn cold outreach warm, right?
mhm. Yeah, I love that. Well, I know we're coming down to the end of our hour and like, thank you. This has been super interesting, super fun. And I want to end on that last question. So we're going to come back to it. What is one shift founders can make right now that could materially improve how they are thinking about capital for their
I,
company?
I already gave I'm gonna unfortunately my answer hasn't changed from I kind of accidentally foreshadowed. I think
That's fine.
find a capital mentor. Like find someone in your industry. Like it could be it's not even necessarily someone who's going to be able to help you get that capital, but find someone who has worked inside a company that looks a little bit like yours and has had some experience with the capital stack that company like that used. And then you might look at someone, a company that's further along, but where they're like corollaries, right? Just
Mhm.
finding someone that knows more than you do about so I'll give you a concrete example. We have a company in our portfolio that makes size inclusive PPE. And she landed this huge contract. I mean, like game changing contract. But then she was hit with the reality of having to fund the inventory to fulfill that. And it's just not, you just can't wake up one day and do that. And one of the things that, she realized she should have done sooner was really work with a CFO who understood inventory financing at scale, because she didn't even have her modeling done well enough to go to the larger inventory financing organizations to even start to, make a plea. Because I mean,
Mhm.
she has a signed contract from her very well. Like it's very
Yeah.
fundable, but you don't just
Mhm.
like show up one day with a thing and says, pick me now, because the first
Right.
thing they ask for is like, send us all your stuff. And so like her modeling isn't done the right way, right? So she had to take a hot second and go back and do that. And then we sort of
Mhm.
all rushed to like kind of backfill. So I guess this is kind of related. Don't wait for the opportunity to kind of backfill some of the capacity gaps. So one thing you want to make sure that you're under, like, if you don't totally understand how a company like yours matures over time financially, and most of you shouldn't, by the way, like that's not what got you started. Wasn't because you understood like what a company like yours would look like, at scale. Like that's you, it's not there's no shame in it. But sooner rather than later, start working with folks who have encountered the problems you're likely to encounter so that you can start to think about them sooner and even change your internal modeling so that you can just start to wrap your head around the different friction points and pinch points that you're going to have as you go. Right. And I think a lot of times we end up with these really basic financials that just show that a 10% increase in spend will result in a 30 or 40% increase in revenue, and then you say you're going to add 3 employees, period. Right. And you're like, that's how it happens. Okay, like that, okay. But as you start to get closer to actually finding some momentum in the market, there's more complexity to that, to your business, right? So I would say, in addition to just finding a capital mentor might sound too esoteric, but start to think about that. And then also get the support that you need to understand how to really match the pattern, right? I think it's easy to say, like again, everyone thinks they know the answer, right? Until they're actually trying to solve the problem. Figure out what do you think you're going to be eligible for, and when and how, and then you can actually start to think about, maybe you're not selling the story the right way. Like I had a company that I was working with that had a lot of opportunity, but it wasn't going to be through hiring a lot of direct sales. It was going to be through but through these channel partnerships and through distributed sales, right? And the minute we sort of explored that, did a few tests, showed that it worked, and then the capital optionality like really opened up because it became more credible. The investor knew that you would never build this company by just adding more people to sell. They knew enough to know that you would do it, with the support of this kind of distribution network. And it was just something the founder didn't have experience with. So they, once we fixed that, we increased the optionality, and the bringing funding in became easier. So part of it is just kind of understanding what kind of company you have, what are your growth levers, like we talked about earlier, and then what kind of capital you think can you kind of reasonably predict you're going to need when, and then you just sort of take some deep breaths and ask yourself, what sacrifices am I willing to make to match the pattern, right? So if you want to sort of go this way, maybe you're not quite sure. You can always change your mind, like if it doesn't work out on the storytelling side. But I would say, just try to get some folks to help you think a little further out from where you are. And if you're struggling, kind of go back to that core question, sort of, what am I? Who am I? And am I matching the pattern? So I know it's kind of like a free flow. How well,
You
like I
know
was like,
what?
I was like reading my journal, my dream journal to you. But yeah, just find someone that understands more than you do about the economics of a company like yours at a slightly more mature scale, so you can begin to prepare, and then, God willing, prepare and anticipate having some of those problems yourself.
I love that. Well, Melissa, I can't thank you enough for taking the time to hang out with us
My
today. And
pleasure. My pleasure.
yeah, it's super interesting, super fun, and really a different way. Again, like for folks that are always kind of chasing that fundraising, just to take a minute, take a pause, and kind of think about like truly what's that strategy. And I love that we're taking the time to kind of think through
Yeah,
and maybe think about
I don't
some
know.
other ways.
One last pitch.
Oh
If
yeah,
you
go on.
haven't raised money before, my friend Allison Byers just wrote a book called Fundraising for the Rest of Us. And they're like the ebook is like 99 cents. It just came out. It's called Fundraising for the Rest of Us. And it's especially good for founders, like first time founders who haven't raised money before. And she does a lot of work to kind of demystify like all of the kind of chest thumping language around fundraising and some of the more practical realities about the patterns that are actually there that you just might not know about. And she's just a great communicator. And the book just came out about, I don't know, like a month ago. So if you're really new and you just want to like not have any ego around it, fundraising for the rest of us is a great option.
I love it. Now we're going to start our own like startup prize book club, and
Book club, yeah,
I
yeah.
know,
Well,
right? We
yeah.
really should.
Thank you so much for having me, and
All right.
happy to keep in touch with the founders.
Yes, I love that. All right, everyone. Thanks again for joining us
Bye.
today, and we
Thank
will
Thank
see you
you.
next
you.
time.
See ya. Bye.
Bye.